Price moves up, but it cannot stay above. The session forms inside old pressure. April 27th Asia session forms between April 17th U.S. session midpoint and April 17th U.S. session upper boundary. It forms compressed. Price moves up. It breaks above April 17th U.S. session upper boundary. Then it reaches April 27th U.S. session lower boundary. It tests. It slows. It cannot keep distance. That is where the short starts to form. Short entry line. April 17th U.S. session upper boundary. Stop loss line. April 27th U.S. session midpoint. Take profit line. April 27th Asia session lower boundary. Price broke above, but it could not stay above. That failure creates the short. Now the stop matters. A tighter stop at April 27th U.S. session lower boundary gives a better risk-reward ratio. It looks better. But earlier candles already tried to test April 27th U.S. session lower boundary. That line is already under pressure. Price can touch it again. The short can still be valid, but you are already out. So the safer stop sits at April 27th U.S. session midpoint. If price reaches that midpoint, the short has lost control. That is real failure. Price drops. It returns inside April 27th Asia session box. It reaches the lower boundary. The trade pays. Then trailing can begin. First trailing target, April 21st U.S. session upper boundary. Second trailing target, April 21st Asia session lower boundary. Risk-reward ratio, 3.25. But trailing only works when the stop moves too. If the target moves lower and the stop stays behind, that is not management. That is hope. If the stop moves too tight, reaction touches it, then the original trade pays more than the trailed trade. Better ratio is not the goal. Survival is the goal. Price reaches. It fails. It returns. That is the short.